This week, we're asking the big question. Can the Fed fix the housing market it broke? Will interest rate cuts help restore home affordability? We're going to break down all the forces at play and what they could mean for home prices nationwide. We'll do that right after this short message from our sponsor, Liberty Reverse.
Liberty Reverse wants to help you grow your reverse mortgage business with our proprietary Equity IQ product suite. Equity IQ gives your borrowers access to more funds, lowers their upfront costs, and expands eligibility for home purchases. Learn more at partners.libertyreversemortgage.com today. This ad is intended for mortgage professionals only and is not a consumer solicitation. PHH Mortgage, doing business as Liberty Reverse Mortgage, is an equal housing lender. NMLS number 2726.
Welcome back, and thank you for joining us. Let's begin this episode with the current state of today's housing market. Right now, home sales are at their lowest level we've seen since 1995. Yet, according to Census Bureau data, which was cited in a recent bank rate column, we now have 46 million more Americans aged 30 to 39, the home buying age, than we did 30 years ago. And then you add to that the U.S. population has increased by 80 million more individuals over that same time period. And you would expect that housing demand should be through the roof. But as we know, it's not. Instead, the housing market is frozen. Why? A lack of affordability. The Atlanta Fed's Home Ownership Affordability Monitor reveals that a median-priced home today will eat up nearly 48% of the median household income. And from mid-2020 to mid-2025, the typical principal and interest payment on a U.S. home has more than doubled. In fact, it's jumped 126%. So can the Fed fix the mess that it made? Some say no. Doug Duncan, former chief economist for Fannie Mae, points to the Fed's pandemic-era policies, saying, the role is having driven real estate interest rates negative and nominal interest rates essentially to zero, which brought mortgage rates down to the 3% range for a sustained time period. There was no rational reason why rates should have been that low, that long, or even that low to begin with. But the fact that rates were that low for that long moved a whole bunch of people forward in time with a once-in-a-lifetime opportunity to lock in an unreasonably low interest rate. Of course, that stimulated demand, which did accelerate the pace of price appreciation. And it wasn't just interest rates. The Fed also bought up trillions of dollars in mortgage-backed securities, which injected massive liquidity into the housing market. Chris Thornburg of Beacon Economics points out that between mid-2020 and the end of 2021, national home prices surged more than 50%, calling it the direct result of the Fed's preposterous, as he calls it, flood of money into the housing market. Now, many argue that if the Fed simply cuts rates again, affordability will return. That's what we see in the mainstream media. But would it? Let's run the numbers. At today's median home price of about $443,000 with a 20% down payment and a 30-year loan at 5%, let's say the rates have come down, the monthly principal and interest payment comes to about $1,900. But if price is corrected by 30%, that would bring the home down to $310,000. And if you financed at today's interest rates, which are about 6.5%, the monthly payment drops to about $1,568. That's a savings of $334 a month. That is significantly better than what a series of Fed fund rate cuts could ever achieve. To put it simply, every 1.5% change in mortgage interest rates offsets about a 20% change in home prices when it comes to monthly affordability. So here is the bottom line. The Fed cannot solve a housing affordability crisis using the same blunt tools which helped create it. And while the Fed funds rate does influence short-term borrowing costs, or the overnight rate, mortgage interest rates are tied closely to the 10-year U.S. Treasury yield, which, by the way, is influenced by inflation expectations, global capital flows, and investor confidence. But here's the rub. If investor confidence begins to weaken due to our national debt, faith in our dollar, or, yes, our government's creditworthiness, investors will demand a higher yield to offset the perceived risk, which would drive mortgage rates even higher than they are now. All which means while lower rates may help around the edges, Real affordability is not going to return until we see wages catch up to home prices or home prices come back down to earth. Now, with wages growing at just about 3.5% to 4.2% annually before inflation, it would take more than a decade for incomes to close the gap created by a 56% surge in home prices. And that's not a likely outcome. A more plausible solution is a significant correction in housing prices in the hottest market in the next 3 to 5 years. And that's something that any mortgage professional or I don't want to hear, but it's a likely outcome that we should prepare for in the most overvalued markets. So can the Fed fix the housing market it broke? You can share your comments in the comment section below. And if you would like to share this video on your LinkedIn network, we thank you for that. Don't forget, we have a YouTube channel where you can subscribe. That way you never miss any of our recent content. And if you want to catch up on your most recent reverse mortgage news, we have the solution for you, our weekly podcast, Heckam World Weekly. We have both a video and an audio edition. Listeners can listen and subscribe on Apple Music and Spotify. Thanks so much for stopping by, and be sure to return next week for more reverse mortgage news, commentary, and analysis you'll only find right here at Heckam World. Have a great week.